Welcome to Call Wiz, where we break down earnings calls. Today, we are breaking down ASML Holdings' second quarter of 2026 results from the call held on July 15th, 2026, with CEO Christophe Fouquet and CFO Roger Dassin.
Good to dig in with you, Alex. The headlines look strong, but I want to test the drivers and the multi-year capacity talk.
Absolutely. Starting with the quarter itself, total net sales hit 9.3 billion euros, above the high end of guidance mainly from installed base management sales of 2.8 billion euros, almost 300 million euros above what they guided. Net system sales were 6.6 billion euros, including 3.8 billion euros of EUV system sales with one high-NA system inside that, plus 2.8 billion euros of non-EUV. The split was nearly even at 51% logic and 49% memory. Gross margin came in at 54%, also above guidance thanks to very high margin components and installed base. Net income was 2.9 billion euros or 31.3% of sales, for earnings per share of 7.59 euros. Cash and short-term investments ended at 7.6 billion euros, with free cash flow of 1.3 billion euros. They bought back about 1.1 billion euros of shares and paid the final 2025 dividend of 2.70 euros per share.
Those numbers line up with the filings, too. The quarterly income statement shows revenue of 9.33 billion euros, gross profit 5.04 billion, for exactly 54% margin, operating income 3.46 billion for 37.1%, and diluted earnings per share 7.58 euros. Looking back, fiscal 2025 full year was 32.67 billion euros revenue at 52.8% gross margin and operating income 11.30 billion at 34.6%. So this quarter already sits higher on both revenue and margin trajectory.
Right. For the third quarter, they guided total net sales between 11 and 12 billion euros, installed base around 2.9 billion euros, and gross margin 55 to 57%. Then they raised the full year 2026 outlook to total net sales of 43 to 45 billion euros, with gross margin 54 to 56%. That is a clear step up. Christophe said the primary drivers are continued strong customer demand, plus their ability to drive higher output through supply chain, manufacturing, and field teams. Customers revised CapEx plans upward, and ASML met the extra lithography requests. Advanced logic foundry-related net system sales are now expected to grow over 25% this year, and memory-related net system sales over 75%.
The memory number jumps out. They pointed to supply challenges lifting DDR and HBM prices, so customers add meaningful capacity this year, plus plans for multiple megafabs later. Lithography intensity is rising as they migrate nodes and replace multi-patterning with single-expose EUV. Purely as a thought experiment, if memory net system sales really grow over 75% on top of the logic growth, that would push the full-year midpoint of 44 billion euros, well above the street consensus that was sitting around 40 billion euros going into the print. But does the filings history support that kind of step? Fiscal 2024 was 28.26 billion, 2025 32.67, so the jump to 43 plus would be the biggest acceleration yet.
Fair challenge. On the system side, Roger quantified the pieces. Around 65 low-NA EUV systems this year for over 45% year-over-year EUV net system sales growth, about 130 immersion DUV shipments similar to 2025 levels after they re-accelerated output with the supply chain, dry DUV up markedly, and non-EUV net system sales overall growing around 25%. Installed base management is expected to grow over 30% on EUV service plus performance upgrades. China remains around 20% of total net sales, rising in line with the overall business mainly from mainstream logic.
That installed base strength is interesting because it beat by 300 million this quarter and they are guiding it higher again. Christophe later said, customers want more capacity from existing fabs as quickly as possible given clean room constraints. So, upgrade demand is strong across every version of low-NA EUV and immersion tools, and they plan new upgrade products for 2027 and 2028. If we run the thought experiment on those numbers, the combination of service from a growing EUV base, plus upgrades could keep installed base as a high-margin buffer, even if system mix shifts. The counterpoint from the filings is that free cash flow was only 1.3 billion this quarter after a negative 2.61 billion in the first quarter, while full-year 2025 free cash flow reached 10.65 billion with buybacks of 5.72 billion. So the cash conversion is still lumpy while they invest and return capital.
Exactly. Now, the multi year capacity comments were the real meat. They are close to fully covered with orders for low NA EUV in 2027 and plan to increase low NA EUV capacity by around 30%. For 2028, they have already received a significant number of low NA EUV orders and are investigating a further 30% capacity increase. Same 30% for immersion in 2027, investigating another 30% for 2028. All of that is inside the existing footprint by optimizing clean rooms and cycle times. No new clean room needed for these steps. Roger noted that the tool mix next year will be S and Fs versus Bs and S this year. So the 30% unit increase actually delivers about 45% more wafer capacity, plus install base upgrades on top.
Let me play devil's advocate. They keep saying demand is still fluctuating and they are not waiting for purchase orders before preparing. But they also said they have not reached a stable state for 2027 demand yet. Purely as a thought experiment, if the 30% capacity adds land and the higher productivity mix comes through, revenue could keep compounding hard into 2027 and 2028, consistent with the street estimates that already have 2027 at 50.22 billion euros. But the filings show inventory still elevated at 11.74 billion euros, cash and short-term investments at 7.58 billion, and R&D running at 1.28 billion this quarter after the technology and IT transformation costs. So execution risk on the supply chain and OPEX discipline is real if demand softens.
Good steel, man. On High NA, they announced that Intel Foundry is using High NA EUV on the Intel 18A process node to produce a subset of its Intel Core Ultra Series 3 processors, dual qualified at yields matched to the NXE platform, with product shipping to customers. Christoph called it an important step showing readiness in a production environment and said they continue to work on maturity toward high-volume manufacturing levels. They still expect 4 to 5 high-NA systems recognized this year. On pricing, Roger said the current high-value environment for customers gives more flexibility than in the past. And low NA productivity increases create a runway for potential price improvements, though long lead times mean it will not hit tomorrow.
So for the bull-bear exchange, I will take the bull side first. Extrapolating just for the sake of argument from the call, the combination of over 25% advanced logic growth, over 75% memory growth, 30% capacity steps for 2 years, rising litho intensity, better mix to E and F tools with higher ASP and margin, plus installed base, over 30% growth and pricing flexibility, points to multi-year revenue and margin expansion that could support the 43 to 45 billion this year and keep the operating leverage improving as OPEX grows slower than sales. The filings already show gross margin climbing from 51.3% in 2024 to 52.8% in 2025 to 54% this quarter, and free cash flow was 10.65 billion in 2025 with buybacks of 5.72 billion.
I will steelman the bear side with the same evidence. The call itself flags that high NA still needs maturity to deliver the cost benefit versus multi-patterning, low NA plus immersion. Demand signals for 2028 are strong but not yet full purchase orders. China's still 20%, and OPEX ran higher this quarter on the transformation. Looking at the filings, operating cash flow swung from negative 2.19 billion in the first quarter to supporting the positive free cash flow. This quarter, inventory is sticky around 11.7 billion, and historical R&D has climbed steadily from 3.25 billion in 2022 to 4.30 billion in 2024 to 4.70 billion in 2025. If capacity ramps lag or AI-related intensity cools, the raised guidance could prove optimistic and margins could stall below the 56% exit they are implying for the second half.
Fair. The counter to that bear view is that they already re-accelerated immersion output this year and are optimizing existing space for the next 30% steps without new clean rooms. And Roger said if customers ask for more, they will roll up their sleeves again as they did recently.
Agreed. Looking ahead to next quarter, the key watch items are whether they deliver the 11 to 12 billion euros sales with 55 to 57% gross margin. Any further color on 2027 low NA order coverage and the exact mix of E versus F tools, progress on high NA maturity beyond the Intel milestone, and whether installed base upgrades stay elevated. They also flagged the next Capital Markets Day on June 10th, 2027 for longer-term views.
Quick recap: strong beat and raise powered by AI-driven logic and especially memory demand, installed base and mix helping margins, multi-year capacity increases already underway inside existing footprint, and high NA taking a production step with Intel. All of our projections were thought experiments anchored to the exact figures and quotes from the call and filings.
Exactly. These were thought experiments for discussion only, and none of it is financial advice. Thanks for listening to Call Wiz. Jordan, always a pleasure, and we will catch everyone next quarter.